all to this webinar. Uh, I guess we were all waiting to see what the budget had in store for us, and it's been a very interesting budget this year. So we will sort of, go through it and see, how does it impact us. Uh, to start off with, I will spend some time on the personal finance side. So broadly, when I structure it into sort of three sections, one is on personal finance, the other is impacts on macros and industries and other factors. And the third is about, a little bit about markets and, what is, how is the dynamics of the market changing, right? So that is something that, we can look at, and also that will give us insights as to, what we can do on our portfolios as well. Okay. So, what has been an interesting shift from the last few years is the introduction of the new tax regime. So, you will find that the old tax regime has been pretty much constant and not much changes. I think it's a matter of time before, they take it out, keeping in mind that it's not likely to be beneficial to, too many people. Okay, so that is something that, we can sort of keep in mind. And we'll also, so when does somebody use the old tax regime? So typically you'll use the old tax regime when you have home loan, and now in fact you're allowed to have two uh, self-occupied properties, right? So and without any conditions. Earlier there was a few of them, and so all conditions have been removed, and you can have two self-occupied properties. You can also have properties on rent. So if those deductions are coming high, I think that is the only scenario that I can think of where it makes sense for anybody to use the old tax regime. Okay, so typically for most others, it is the simplified new tax regime. And what was the change in the new tax regime? Basically, the point was towards making it more simplified, towards taking off too many of the deductions and rationalizing the tax rate. The whole point was, why not just make a lower tax rate and take away the deductions so life becomes simple and easier, for us to look at. And this is one place where there's been a good increase in the new tax regime, uh, effectively including standard deduction. you know, uh, you can have zero tax, okay, if you're up to 12.75 lakhs per annum. Okay, there's a big shift, and 12.75 lakhs is a very good number. Of course, this is for a salaried person uh, who has standard deduction of 75,000, right? So if you take that out for a non-salaried person, also it's reasonable in terms of the 12 lakh. So the second part of it also, the slabs have also been, reasonably increased, and so that is something which, is beneficial for, all. And just to sort of give you what is a sense of the tax saving that comes about it, okay, for different, salary levels, this is what it sort of gets capped at almost like 1.14 lakhs. Okay, and the reason for that is as you go higher, you will get the benefits of the increase in slabs. Okay, so that's the peak sort of a thing that you can end up getting. Yeah, so that's the good part about the changes. Almost like I think for many of us, 1.14 lakhs, per annum in pure tax saving, I think is a welcome measure. Okay, there are other things that the budget also has done. One is in terms of lower in terms of self-occupied property. There are two properties allowed, like I mentioned earlier, and so basically, what was happening or what happens now if you pass the two, and let's say you have a third property, even if it is vacant, you have to assume a rental income as if it is let out, even if there was no income coming to you. Okay. But now what it does is if anybody has, let's say, a house for oneself, maybe house for parents, for example, which you bought, and so you are then able to take the tax benefit on both of them. Okay, so that is the benefit out there. The threshold limit for TCS, okay, on LRS, there have been some changes there. From 7 lakhs, it's been increased to 10 lakh of rupees. And for education loans, okay, there was a lower rate earlier, so that has been removed, and there's no LRS required on overseas education of your children. If it is through an education loan from specified financial institutions. Okay, the annual limit of TDS again is sort of increased from 2.4 to big increase to 6 lakhs. And so you can see some of these measures are meant towards simplification. Okay, so what it does is it takes a whole lot of compliance burden from anybody who's renting out a property, because 2.4 lakhs is very, per annum is a very small number. Okay, so it takes off the burden for a large set of people, who are letting out their property. Uh, Even the tax deduction for senior citizens doubled. The limit is doubled from 50,000 to, uh, 1 lakh. And if you look at, so all of these measures are mainly towards sort of simplification. Again, timelines for filing of updated returns extended to 48 months. Of course, that doesn't mean that you don't pay additional interest. So I think it's a smart move from the government that to allow it for a longer period anyway. There is additional revenue which will come to them. Because somebody is filing the returns late. Okay, and taxation of, but it was procedurally it was sort of an irritant, because if you realize that something has been missed out a couple of years back, you're not able to file your returns. Okay, so file an updated return, that is. So that was causing some bit of pain. So this one at least procedurally makes it simpler, though you will end up having to pay interest for the additional period. Okay, and also on some clarity which has been brought on insurance, policies where there are certain conditions for ULIP where it is exempt from tax. Okay, and so these will be sort of uh, they've been brought clarity to it, and it will not qualify under Section 1010D for these ones which don't uh, achieve those limits of 10 times, or 5 times, the life cover required, etc. Okay, and but in such cases, it was gray area, right? So that has now been confirmed that it will be taxes capital gains. Okay, for non-ULIPs that do not qualify for exemption will be taxes income from other sources. So that is bringing clarity again. So I think there are a whole number of things that on TCS, on TDS, etc., rationalization that the government has brought in, to sort of make compliance a little easier. So I'm coming to the second section, of my presentation, which is about the macro. So basically, before I start off, I just wanted to run a poll. Yes, Sanjay, can you just pull up the poll? Yes, I will give maybe a few more seconds for people to complete the poll. Okay, so I think broadly, one minute. Yeah, in the poll here. Uh, so basically, if you see, uh, I think reasonably, people are saying it's positive. A good number, 35 of them out of 55 is basically who have polled, that is. Okay, 64% have come back and said that, we think the budget will be positive, and I think that's sort of where the sentiment is. Okay, so this is good. I saw a couple of hands raised. One will take up questions towards the end. Okay, if it is something that is, relating to the sound or anything, then you can just put it in a chat, and then Sanjay will probably come back. Yeah. Yeah. So basically, so coming back to sort of the macro side, um, I think what's interesting is that the government has sort of kept tax to GDP and some of the ratios static, so not increasing tax as a percentage to GDP. Okay, what's interesting is subsidy as a percent to GDP is sort of getting reduced. So subsidy is sort of seen as a bit of a wasteful expenditure. It's not productive. It's not helping the economy grow in some form. It's only maybe supporting a certain segment of society. Okay, so to some extent, but the social measure at the same time, spending too much spending on that is not good for the economy as a whole, because then it comes and impacts in other ways. It comes and bites back where the spending on these factors are high. So the good part is a 0.1% sort of reduction, and which is also a good thing that to see out there. The other part is also capex to a percentage of GDP, and what is capital expenditure and why is it important? It's basically the government spending on all roads and other sort of areas, and so that is something which roads infrastructure and stuff. And so when it does that, it's first of all it's improving infrastructure, and it's been seen that in economies where infrastructure sort of improves, you're providing the ability for industry to then build on it, and an efficient economy is created and stuff. And so that sort of helps the economy does well. So you will see that in many countries, if you see right from Singapore, right from if you go back to Dubai, if you see even China, etc., where infrastructure sort of improved, automatically there was growth, including in the private sector, and it enabled growth. Then what's another important one is on how much of interest payments, okay, to your receipts. So that interestingly is sort of going up from 36.2% to 36.5%. Okay, ideally that we would have been better off, but actually it was sort of coming down, because that's how much interest, as you're finding, interest is a bigger part of your expenditure, right? And coming back to various other factors which you see, I think broadly, gross fiscal deficit to GDP coming down from 4.8 to 4.4%. If that happens, is very, very good. If you see the chart to the left, you'll find that we had sort of been coming down reasonably well, okay? But I think COVID came and sort of changed the base, okay? And it's if the government sort of reduces fiscal deficit in a sudden and sharp way, it impacts the economy, and which is why typically it is done in a staggered way. So you'll find that today it is reasonably moving downwards again, the trend. So that's also a very very big positive. And so even if you see other factors like revenue deficit to GDP and primary deficit to GDP, I think all are sort of doing well and coming under control. Okay, why possibly interest rates are going up is the last one, because the gross market borrowing of the government is sort of going up. Okay, and along with interest rates, etc., I think you're finding that interest payments to total receipts is sort of going up a little bit from the current year. Uh, there's a whole lot of thing on macro stability, fiscal consolidation, etc. I already spent some time, so I'll run through these a little bit. Okay, but that's the direction, and it is very good because otherwise, what happens? It sort of forces the government to borrow more, and if the government borrows more, then you also find interest rates sort of going up, increase in inflation, etc. Fiscal deficit being under control is sort of important. And the government has been focusing on capital expenditure, right? And capital expenditure is very, very good for the economy as a whole, and also for the long term, as long as it's productive. Okay, and that is something that the government has been focusing towards. The government has also been focusing on projects which are financially viable, and so that caps the number of projects that one can do, because every time you're looking at, is this project viable or not? If it's viable, then it makes sense for you to sort of do that. And so efficiency also in CapEx is being given attention to, which is, I think, very, very good. You found that in countries, in the past, where they did not pay attention to it and only CapEx happened while there was growth for some time, in the later part, you find that, it comes and bites you back. So CapEx has been sort of good there. Again, the outlay sort of as a percentage of GDP also has been sort of increasing. Okay, so that brings me back to within, the impact of the second section that I said, macro and sectoral, is where I'll spend, again, I'll take it a little quickly, but one of the sectors, auto ancillaries, I think just the increase in disposable income is going to sort of benefit there. There have been some of duties which are reduced, especially in lithium batteries. So that's going to benefit for electric vehicles. And today there's a good shift towards it, and I think that's going to be reasonably positive. Building materials is sort of neutral, other than possibly I think it's continuing in a similar trajectory. uh, so there's nothing. I guess the ancillary benefit of infrastructure and other areas will sort of keep it, I think, neutral rather than being negative. Okay, chemicals. There has been a custom duty reduction in lithium ion, in specifically some of these chemicals. Uh, but otherwise, I think little untouched. The government has been trying to see how to promote Make in India, and look at other areas or other ways to also make it easier to manufacture and stuff. So, which is also, a positive impact is what we expect there. I think a big positive impact is going to come on the FMCG side. Okay, of course, now FMCG and you know uh, consumer discretionary type of a thing, all of them, I think, are going to benefit from the large tax saving that has been rolled out, by the government, and that's sort of going to do well. The government has also been focusing on rural development, and that will also, I think, add to FMCG growth in rural areas. So I think broadly, a budget which sort of tries to, encourage growth. IT is the other side. Okay, IT also, the GCC centers, in emerging to tier two cities, etc., have been focused on. Okay, and government also trying to see how and giving some allocation to a center of excellence in AI. Okay, that's a good start for us. Okay, so that's a positive. Industrials, I think, thanks to the capex of the government, you will find that industrials will also benefit from it. There are other areas like, you know, asset monetization, is sort of planned so that, it can come bring in almost like 10 trillion. Okay. So that is something which can sort of help, further grow. Uh, and there are aggressive targets by the government in terms of spending out there. Again, the EV battery side, etc. So you'll find that industrials are likely to do pretty well. Okay, BFSI is the other one. I think you will find that various measures that have been brought in, schemes, etc. For MSMEs also, there has been, turnover limits has been sort of increased. So many of these, along with the consumption uh, pending, increase that has comes in, and the lower, tax rate, lower taxation that comes in, because all of this will flow in through the BFSI, through the banks, right? And then probably some will go into savings, some will go into various other places. So this is also likely to sort of have and benefit, the BFSI, sector. Of course, at a time like this, there are some, you know, caution that people are coming back and looking at and suggesting on in non-performing assets. So that is something that I think one will be watchful of. Okay, so this is something which is there. Second house again will benefit housing finance companies, and so that's going to help the BFSI sector. Consumer durables is something again, will benefit from the increased money in the hands of the consumer. Healthcare pharma, there have been some rationalization or reduction in custom duties for some 36 life-saving drugs for cancer, etc. And there's also some focus on medical tourism and promoting that. So I think the government has been proactively working on even creating of, focusing on hopefully spur the next set of growth while, and I think that's a good idea that they keep also moving some of that. Oil and gas, I think, uh, so this is with subsidies, low subsidies, this is going to have a bit of a impact out there, especially on the LPG side. Okay. That brings me back to, sorry, this brings me back to the last section, which is on the market dynamics and, what is likely to be the impact and stuff. Okay. Uh, so broadly, if you see the growth trajectory in earnings, which is basically, the profit after tax, okay, of the Nifty 500 companies, which you see here, which is illustrated here. There was a, improvement from say 2003 to 2008, which was a reasonably, steep one. Okay, then you found that the earnings, the first chart, the top chart, was very flattish. After 2008, there was a little bit move up there, but then again, if you see 2010 to almost 2016 was, sort of flattish. Okay, and in probably even post that right up to 2020, right? So was in a range which was not, moving up as quickly as what one would have liked it to. Okay, but the expectation from 21 to 20, or from 21 to 25 has been very good. Uh, there has been some, bit of a slowdown in this year. Okay, and that is something that uh, you know has impacted, but we'll look at it. What is the expectation from here, right? So broadly, the point is that, while markets have gone up, you are finding that the profit profits of companies have also gone up, like at a 24% CAGR from 21 to 25, okay, which is very, very healthy and very good. So that's been, a good aspect for it. And now just coming back to a bit of a reality check, because the 25 was a little muted, or is a little muted. You will find that it was growing faster. In some periods, it's grown like 20 to 37% and 26%, etc. Okay, but if you see from 25, financial year 25, is likely to end very weak, okay, in terms of earnings growth. And uh, in fact, that was when people asked me before, what do you expect of the budget? My view was it's going to be positive because somewhere, it is now on the government's agenda because the economy has taken a bit of a pause. Okay, so I think some of the steps and the cutting taxes, I think, and also, the capex, continued capital expenditure growth by the government are all measures, in my view, keeping in mind the current environment. And I think it was asked expectation as well that, while this year is muted, we think that the next year is again going to come back to, higher growth rates. And so that is something that, we think is going to also benefit markets. So if we come back and say, what is our expectation, keeping in mind, the poll that we ran, right, is because of some of these factors, we think growth will come back in and hopefully markets then should do well. And corrections are always what we believe are always a good point to create for entry points. If you, have been disciplined in your investing style. Uh, the other aspect that one wanted to highlight was, for a period of time, companies with neither quality, neither growth. Okay. So the Nifty, so the NSE 500 companies were sort of broken up into uh, three categories. One is which are the ones with quality. Okay. They had it such that the ROE is above a certain percentage, return on equity, that is, okay, so as a measure of quality. For growth, they had growth above a certain percentage. Okay, and then these two factors you looked at, you'll have companies that the periods when, either quality does well, sometimes growth does well. Okay, as a style of, investing and picking up companies. So, so you found that in calendar year 24, companies which had neither quality, neither growth, okay, ended up actually growing faster. Okay, so and if you go back and see the top table shows, right, in the on a 10-year period, quality and growth, they delivered 30%, right? And neither quality, neither growth delivered 18%, right? So that was the difference. Okay, whereas if you looked at, if you didn't categorize companies and just say, okay, all the 500 equal weighted without giving a higher weight for any particular company, because normally the, let's say, Nifty 500 index has higher weights for companies that, do well, right? So it's skewed to, so if you do a weighted average, it'll be again skewed to companies which are sort of doing well, right? So to that extent, if you look at equal weighted index, okay, and you saw what is it against that, is more reflective to say, okay, versus a base, what is it? Okay, so you'll find that maybe on a 10-year period, it's a no-brainer that, quality and growth, you have both quality parameters and growth parameters together, then it's likely to do very well. What is interesting is if you look at it on a 1-year basis in calendar 24, okay, quality and growth delivered 26%, it was least performing. So if the company was, had a good quality of earnings and it was growing faster, it actually was punished. Okay, why? Because uh, the market moved towards value. Okay, so and when market moves towards value in the last 3 years, and we'll see a chart towards that as well as we go forward, you found that quality and growth underperformed even the equal weighted index. Okay, so that is something which is there, and you'll find that on the other hand, neither quality neither growth delivered 59%. Okay, so that's our point that we have been trying to say that, if in this period, there have been some funds which have underperformed, or even if you are in line and you have been able to manage quality and growth, then you sort of, are doing very, very well. Because this is likely to reverse. And I think it's a no-brainer again that we go back to quality and growth, right? And of course, there is a little bit of shift which already started happening, even in the calendar year. So, which is the right side, if you see what we've captured, okay, that you will find that quality and growth delivered, 4% in, say, June to December, and whereas neither quality, neither growth delivered -3. So that is a point that one is sort of making out there. Of course, on the left-hand side, the bottom table is about alpha, which we are saying. let's say quality, how did quality and growth on a 10-year basis, for example, was 30%. We're saying versus the equal weighted index, weighted universe of the same 500 companies, delivered 23. The bottom table is just saying what's the different alpha. That is, quality and growth did 7% better, in that period. So just was explaining that, table below that. So to summarize, what one is saying is, yes, in the last 3 years, some of the junk has also run up. Okay, and because and why does it happen? It happens because these companies may have been beaten down so much. Okay, that people see value in that, and so the value style sort of did well, and they said, okay, this is too cheap, so let me just buy. Okay, not saying that okay, this is better quality, let me buy. Right. So that is the perspective of investors when they are willing to take a little extra risk. Okay, this is the period that we saw. However, we are saying that as we go forward, we think that is likely to change. And this is another chart which sort of brings that out. So growth style, is almost at a 15-year low. Okay, uh, and which is you'll find that it always keeps reversing back. Okay, so you'll find that this chart, the graph, right, moves from the top to the bottom and back to the top, right? So the point is when it's at the bottom, you have to be cautious actually, okay? And you need to now. So our view is that in the next phase of growth, next phase of the market, I think growth as a style is likely to do well, and which is where we've also positioned our portfolios there. Okay, and again, another way of looking at it and saying, okay, in each year by year, right? So which did better, right? Here you have certain indices also today, which are Nifty 200 quality index. You have Nifty 200 value index. You'll find that so whichever year, say, quality did better, we said, quality is the winner and vice versa. And you'll find that, and this is my point, like from 2021 to almost calendar 24. In fact, for part of calendar 24, you ended up finding that value did better. Okay. So, and it's now coming back to quality and potentially probably growth as well. Okay. We are already seeing in this year, so you'll see right from May 24 is where the some bit of a change happened and quality has been sort of doing better. And that's normally seen where you see volatility in markets. Okay. Uh, and the other point to make is, which is why the emphasis for us is on quality. Okay, is that if you see a long term charts like history of long term, okay, you 10 years basically, CAGR, you'll find that the small cap index has delivered 17.76, but the top quartile is almost like 40%. Okay, but the bottom is 4.5. Okay, so that's even worse than probably a fixed deposit in that period, right? So the point we are making is it's important, and this is just a quartiles, of course, there will be in between, there'll be two other quartiles in between. Okay, but we are just, to illustrate, we're taking the top and the bottom. So if you are in the bottom quartile and the companies are not performing, okay, then you will see a very, very poor, growth out there. Uh, so my thought was to, give more time to questions and stuff. So I said, let me do a shorter presentation and give some time to you to ask your questions. Okay, so to summarize, I would say that this budget has been a very progressive budget. It has actually looked at and it's addressed some of the issues that the economy is facing today. So I think the big one is about lower tax, lowering the, rather higher tax limits, but higher tax slabs out there, okay, which is benefiting, individuals, okay, and basically lowering the tax per se. This will actually need the tax, breaks are likely to lead to a consumption boost. Okay, so and because what would you do if an individual has it, gift from the government of almost let's say a lakh per year, right? So partially you'll probably spend it, partially you'll probably end up saving it. Okay, so which is where some of it will help boost consumption. Some of us may go and buy the costlier consumer durables, etc., and stuff. So you will have discretionary consumption also doing well, and some of that money, like I said, savings. Not everybody spends, but it will go probably into SIPs or into FDs or just lie in the banking system. So all of which will have positive benefits. The other part of it is, which is apart from the tax cut, I think the overall direction of the budget, again, I think is very good from the long term. It's likely to focus on sort of creating employment. It's likely to and all of this they are also doing while trying to create efficiency. And I think that's a very, very good aspect for the government to focus on. Because a lot of the time, including global governments, just go and spend more money, right? And that's not enough. If you spend it a little, because if you as a government also are indiscreet in your spending, it'll come back and bite you with you know interest being higher, and then you will find your currency will weak and stuff like that. So that is why it is sort of important, and I think it's a very balanced in that way, very progressive, because they're also looking at efficiency. They are looking to improve the infrastructure, add capital spending out there. So that is something which is the other one. So the massive capex thrust by the government is likely to help do better. And like I said, also while looking at areas which are performing, so which add to the infrastructure and add to potential long-term benefits for the citizens. So that is something which is a huge plus. There also have been, interestingly, they started targeting new industries, okay, and showcasing them and trying to see how they can make them move and get better. And that again is another long-term interesting one, because there are areas which including leather, including toys, etc., which has come into focus by the government, okay, which maybe is suitable for India to manufacture, okay. So and but it's not anywhere close to a leadership position in some of these, though maybe in certain areas it was in the past. Okay, so that bit of focus by the government, I think, will also help pull up those industries one by one, and I think that's an interesting way to do it. Renewable energy is again a continued thrust. You have simplification measures. One spoke of a lot of them. Actually, there are many, many more. I've not covered a whole number of them. Okay, but so simplification measures are definitely something that the government has been focusing on. Yes, it's always uh, one keeps on wondering whether things are becoming simpler or not, because in day-to-day stuff, while it is a stated intention, sometimes in action it's a little different. I think this time, I would say for one of the first times, I am seeing a whole lot of measures which are purely towards simplification. Okay, so so I think this time the government has, I think, actually followed through in working towards its stated objective. Okay. The monetary policy has also supported. Okay, of course, this is not in the part of the budget. Okay, but with the rate cut, yesterday, so that is another boost. Also, the RBI, even before the budget, added liquidity. Uh, so all of these, I think, are measures that the government is sort of looking to do, keeping in mind the economy has turned a little weak, and not wanting it to go off into a more weaker and a larger cycle. Okay. Of course, I would say part of the problem arose because suddenly government spending slowed down. Okay, and that slowed down because of elections. Okay, because during elections you cannot, the normal budget the previous year was basically a vote on account. Okay, and then the budget came in, subsequently after the government came in place. So over half the year over, right? So when you have a situation like that, by the time the spending starts trickling down, and the projects get approved, etc. They lost almost like a year, and that sort of hurt the economy. Okay, so but the good part is the government is, at least from what we can see, is wanting to play catch up. Okay, and if that happens, that will actually be, a pleasant surprise on the upside, is what we think will happen. And so, what's an approach that one can take? One can continue to invest in equities in a phased manner, is what we think, is a way to go.